Ever wondered if you can take up a loan using your crypto? The short answer is yes. Just like a traditional loan, you can take up a crypto loan for personal emergencies, capital for business, and to earn interest. What's more, you can even lend your crypto to others. But how do you do it? Is it risky? And what's the difference between CeFi and DeFi loans? That's what we're going to find out in this video. Remember to like, subscribe, and hit the notification bell to be the first to know about the latest in crypto. Let's begin. So, why would you need to take up a crypto loan? Well, there could be four main reasons. Number one, non-taxable liquidity. For investors or holders who like to hold the crypto assets in their account, obtaining loans against their collateral to receive fiat currency is one of the best ways to avoid taxes on gains. Number two, arbitrage trading. This is a way to maximize your potential earnings by borrowing an asset from one platform and then lending the asset on another. Number three, margin trading. The purpose of this tactic is to leverage your gains by obtaining crypto loans and buying additional collateral without going through a centralized exchange. Number four, flash loans. Crypto loans usually require collateral, but flash loans are a form of uncollateralized lending. This is where you borrow crypto to execute other operations and then pay back the loan immediately, all within the same transaction. Flash loans are commonly used for arbitrage trading to leverage higher levels of liquidity and earn extra profit. So you can see now some of the ways that crypto loans can be used. But the true beauty of crypto loans lies in the fact that it doesn't require a credit rating check. Unlike loans from traditional banks, all you need is your crypto as collateral. Furthermore, approval times are faster, and you retain full ownership of the crypto assets. Because you're using your crypto as collateral, you would need to keep an eye on the collateralization ratio. If the value of your crypto assets fall below the required collateralization ratio, your assets will be at risk of liquidation. Otherwise, upon repayment of loan plus interest, your crypto assets will be released back to you in full. While you can take up crypto loans, it's important to know whether it's a risk worth taking. And to know that, we'd first need to understand the differences between CeFi loan and DeFi loan. CeFi, or centralized finance crypto loans, are loans provided by centralized entities that act like pawn shops. They take collateral in the form of cryptocurrencies and provide a USD loan. You can take up a crypto loan on centralized platforms like Nexo, Binance, or FTX. Centralization itself implies that there is a single point of failure. These centralized entities may fail, and you may lose the cryptocurrencies that you store on these platforms as collateral. If this is a risk you don't want to take, then consider DeFi loans. Decentralized finance, or DeFi, comprises financial applications that operate through a blockchain, thereby removing the need for users to trust any centralized entities. A smart contract is used to automate the execution of a transaction. It locks in the value of the collateral and payment conditions. This enables you to have full control of your funds and allocate them as you wish. Now, how about lending? While both CeFi and DeFi loans allow you to borrow as well as lend crypto, you'd have more flexibility and benefits with DeFi. Because of the smart contract capabilities, anyone can be a lender, as long as they have sufficient amounts of crypto. This is done through lending pools, which essentially replaces loan offices of traditional banks. Smart contracts are used to pool assets from lenders and distribute them to borrowers. In traditional banks, collateral is required to be placed with a loan. For example, when you take up a car loan, the car itself is the collateral. If you stop paying for the loan, the bank will have the right to seize the vehicle. With decentralized systems, the only difference is that it's anonymous and does not require any physical properties to be used as collateral. Instead, the borrower needs to offer cryptocurrencies as collateral to get a DeFi loan. The collateral that is posted must be higher than the loan amount. In other words, the loan is over-collateralized. While crypto loans seem to have many advantages, it is most certainly not a risk-free endeavor. For CeFi loans, you may be at risk of insolvency. This is because there's not much insurance available, and you may lose all your crypto if the platform provider goes bankrupt. The assets would then become part of the insolvency estate, and you would be considered a creditor in the insolvency proceedings. With CeFi platforms, there is also a counterparty risk, as they may use your crypto deposits and lend them to crypto exchanges, hedge funds, institutional investors, and over-the-counter traders. Your lending platform provider may become insolvent if the counterparties to these trades fail to return the deposits that were lent out. On the other hand, DeFi loans may experience different kinds of risk. While smart contracts have the advantage of being completely automated and transparent, poorly written code may make the smart contract vulnerable to exploits and hacks. There's also an admin key risk. Developers of DeFi protocols may control the admin keys. If the admin keys are not decentralized or burnt, there is a risk that developers may drain the entire protocol fund. Liquidation is another DeFi loan risk. This is when the cryptocurrency you have as collateral loses value and your loan falls below the collateral ratio. This happened on the 12th March 2020, known as Black Thursday, when the price of Bitcoin dropped 45% in a day. This sudden price drop resulted in loans being liquidated for falling below the minimum collateral ratio. Despite the risks, there's no doubt that both CeFi and DeFi crypto loans play essential roles in servicing the crypto lending market today. CeFi loans may be a more straightforward avenue for newcomers, but users are subject to the rates set by these platforms. On the other hand, DeFi loans allow you to control your collateralization ratio and loan management fully. However, the possibility of smart contract bugs and exploits could mean that attackers may be able to drain your funds from the protocol. Whichever type of loan you decide to take up, be sure to do your own research and consult a financial expert. Have you borrowed or lent crypto? What was your experience like? Let us know in the comments. If you enjoyed this video, don't forget to give this video a thumbs up and subscribe for future alpha. See ya!